In terms of the travel sector, I suppose today, first of all, I want to look at the macro scene in terms of how travel markets are performing globally. What you will notice is that there's a strong domestic travel recovery underway, and particularly in those markets that have really big domestic markets, whether that's China, Russia, the US. Obviously, at this point, the domestic recovery is being largely led by leisure travel, but as you'll see soon, business travel is also starting to improve. International travel is clearly lagging, just given there are restrictions in many countries. However, also at the same time, governments in some regions, particularly in the UK and Europe, are starting to relax those restrictions once populations have high rates of vaccinations, and as you'll see, people are travelling internationally. The first important point is to look at the vaccination rates, as that's very much the key to a travel recovery. And interestingly, I've just been listening to all the, the airline and hotel CEOs in their latest round of quarterly reports in the US. And the first question, obviously, the analysts ask is the Delta variant slowing demand for travel? Is it impacting your forward bookings? And consistently, they've all said at this stage there's no material slowdown in forward bookings at this stage, but we'll have to wait and see. Once people are vaccinated, borders are reopened, there's very few restrictions, they will travel, and there's usually an absolutely very quick and immediate response to that travel demand. The global airline capacity in July, and it's sort of at a level that's at about 69% of 2019 levels or pre-COVID. Load factors are still low, but they're improving. And at the moment, where you're seeing most of the airline capacity being added is in Europe for that key summer holiday period. Slide 9 looks at sort of the countries with the strongest travel recoveries underway. And if we talk through the top 10 markets, it's first of all China's domestic market, then it's Russia domestic, then number 3 is Greece, 4 is Turkey, 5 is Mexico, 6 is the US, 7 is Spain, 8's Norway, 9's Colombia, and 10's Portugal. So they're the strongest travel markets, and a lot of those markets are, have nearly recovered, which is great to see. But looking at the individual markets, I suppose, that are more relevant to the companies we have under coverage, the domestic market was recovering nicely up until May at about 70%. And in fact, Sydney and Melbourne, all that highly profitable Golden Triangle route was actually, in fact, one of the world's top 5 busiest air routes. And then obviously we've had all the lockdowns, the travel restrictions reintroduced, and the travel stats have fallen off a cliff, and the poor industry seen another wave of cancellations. So look, at a minimum, it's going to be an extremely tough first quarter 22, potentially a tough first half 22 for the entire travel industry. But what I would note from past experience is that travel demand does return quickly when borders reopen. Australia's perspective on international travel, you'd be aware, I think it was a week ago, the Trans-Tasman bubble has been halted for 8 weeks, just given Australia's COVID situation. And that also, the Australian budget has assumed that, our international borders are unlikely to reopen until mid-22. And then even then, I think we'll only be opening up to sort of COVID-safe countries. Qantas's decision a couple of months ago, where they've announced in order for them to reduce their cost base on international travel, they're going to reduce the commissions they pay to the travel agents from 5 to 1%. Now, that's going to have some impact on the travel agents, particularly a Flight Centre and a Helloworld, albeit it's difficult to quantify at this point. But what I would note is this is, it is the front-end commissions. It's not the more lucrative back-end overrides that are dependent on volume targets. And while, the Qantas deal is a net negative, there are many other carriers around the world, whether it's in the US, Asia, Middle East, which are more leveraged to international travel as opposed to domestic, that face much greater competition, that are a lot more supportive of the agents because they know they need them to fill their aircraft. Quickly look at New Zealand and look at domestic markets holding up nicely at about 90%. And in fact, corporate travel demand's been hovering at about 80% of pre-COVID levels for the last few months, just showing that corporate travel can recover. And in Asia, really, apart from China, which up until recently was back at well over 100% of pre-COVID levels, that's their domestic market, Demand is extremely weak. Look, as you'd be aware, it's a lot of international travel for the Asian carriers. Many of them don't even have much of a domestic market. So, look, Asian airline executives in general are saying that 2021 is going to be just a really tough year for Asia, just given their rising COVID cases and their vaccine rollouts are really lagging the rest of the world. So, just to put some colour how bad it is in Asia, in June, Cathay Pacific's passenger traffic was only 1.3% of pre-COVID levels, and they're targeting it to be at about 30% by the end of this calendar year. So Asia is going to take some time to recover. And we go back to a good news story, and that's certainly the US. Given their high vaccination rates, leisure demand has in fact fully recovered to pre-COVID levels, which is great to see. So when you see on that slide that it says the TSA checkpoint volumes are only at 80%, I just stress that leisure's at 100%. The difference is corporate travel, which is lagging. And look, it's improving week on week. It's currently at 44% of pre-COVID levels. And at these levels, I would suggest that Flight Centre's business isn't quite profitable yet because it's more reliant on international travel. But certainly CTD's US business should be EBITDA positive given it's got a strong domestic focus. So in terms of the corporate travel stats in the domestic US market, what a lot of the travel industry executives are all saying in their calls at the moment is once people return to the offices post the summer holiday period or Labor Day, which is around the 6th of September, they're expecting another material kick up in the corporate travel stats, potentially to about sort of 60% over September, October. And then in January, there'll be another leg up in those stats as, the US companies all do their new financial year budgets. So we've got American Airlines that are saying that domestic corporate travel in the United States will return to sort of 19 levels in 2022. We also show that, US citizens are actually travelling internationally, albeit it's to nearby countries, whether that's Mexico, Latin America, or the Caribbean. And interestingly, airline capacity is above pre-COVID levels to Mexico, Puerto Rico, Dominican Republic, Colombia, etc. And with Europe now open to the US, traffic is slowly starting to pick up. So you'll see in that slide the Atlantic line in green, that's the Americans travelling to Europe. We look at the all-important transatlantic route, and there I'm specifically talking about sort of the US to UK. The industry has all been very eager for this route to reopen because it's the most profitable route in the world, and certainly it would be a huge catalyst for CTD because they've doubled up on that route now with the TNT acquisition, and it's also very material for Flight Centre. Unfortunately, the industry was expecting it to be reopened by now. Recently, the UK has given the go-ahead, but unfortunately, the US government is still, telling their citizens, no international travel, just given, rising, the Delta variant. So they're stopping the Americans from travelling to the UK and Europe at this point. Canada's market up until 2 months was extremely strict, but now you look at, they've got one of the highest vaccination rates in the world. They're starting to talk about reopening borders. So on the 9th of August, the Americans, as long as they're fully vaccinated, will be allowed back into Canada. So that's a huge traffic route. Canada will also reopen really to the rest of the world as long as you're fully vaccinated on the 7th of September. So Canada's borders reopening is again a catalyst for both Flight Centre, probably number one, and two, CTD. We look at the UK and Europe, and look, the UK has been lagging Europe, but it's certainly catching up now that, borders are starting to open up and travel restrictions are easing. But look, what I would say about Europe is the many different countries all have different rules, so it's complicated, and therefore it really does reinforce the need to use an agent. So as I said, look, the Americans are allowed into the UK and the EU, but they're not allowed into America at this point. But look, European traffic is improving literally by the day. I could only get the last lot of official stats being from the 18th of July, and it was at 53% of pre-COVID levels. I would suggest, as we speak at the moment, it's probably well over 60%. So, the company with the greatest leverage to that European summer holiday period or that intra-Europe travel is Webjet. What I would note is it's a lot of low-cost carrier work, so that really doesn't help Flight Centre's leisure business, which makes more money on long haul. But as I said, travel's complicated. What you're seeing is more agents in the UK talking about how they're winning share from the traditional, online customer. And certainly, Flight Centre and CTD's corporate operations in Europe, their volumes are now increasing rapidly, which is good to see. We turn to reporting season expectations. CTD is the only company we're expecting to be EBITDA positive in the second half 21, and look, it's only going to be a small number at best. All companies will be loss-making at the net profit level. What's going to be particularly important is to see with these companies, their third quarter performance versus the fourth quarter. The third quarter, they were all recovering really nicely in an ANZ to the fact that they're probably putting back some staff. Then in the fourth quarter or towards the end of the fourth quarter, we're seeing revenue fall off a cliff. The companies have got that increased staff cost and unfortunately no JobKeeper. So there is going to be a bit of a margin hit there. But really the pace of recovery is just going to depend on each company's business mix and geographic exposures. So look, as always, balance sheets and liquidity positions in this environment is going to be the main focus. We do think these companies are still generally well funded for a low revenue environment in 2021. I mean, the company we have the most comfort with is CTD, given it doesn't have 1 cent of debt on its balance sheet. It's fair to say in my in-store marketing, the company they're most nervous about is Flight Centre, given now it's going to report another material loss in 22 because really it needs Australian international borders to be open to be profitable. And just remember, now that Webjet's changed its year end, it won't be reporting at this time, but it will have its AGM trading update on the 31st of August. And obviously with that, the key will be looking at, is its Webbed business benefiting from that European summer holiday period? So in terms of 22 outlook comments, it is going to depend on vaccination rollouts in each country and each company's exposure to, say, the US, UK and EU, which is reopening nicely, versus ANZ and Asia, where there's travel restrictions and traffic volumes are very low. It's fair to say there's downside risk to 22 earnings, just given the current border closures and restrictions. I suppose the question is really what degree can their offshore operations offset some of the pain in Australia? We just look at each of the companies and where they're at in terms of the outlook. On corporate travel, I think it's important just to stress that, they're not dependent on Australian international borders being open. In fact, Australian outbound travel for them is only 5% of group revenue. And over 70% of their EBITDA now is from the US, UK and EU, which is reopening. So they're still going to have some degree of base profitability in 22. And even in Australia, just remember, again, they're going to have a baseline of earnings because of their strong exposure to the mining sector in Queensland and WA, and also other essential services. And in Asia, really, they're running those operations on a shoestring to save costs, which is relevant to Flight Centre Helloworld. They're very much the late cycle plays because of their material exposure to Australian and international travel. And it's fair to say in the current environment, Flight Centre's earnings have got the greatest downside risk, particularly in 22. Look, we've looked at how the travel companies have performed year to date in terms of share price performance. I think, first of all, it's just worth noting that their international peers, whether it's Bookings.com, the old Priceline business, and Expedia, are trading well above pre-COVID levels. CTD on the domestic front, though, has outperformed peers, given it's got no debt. It's highly profitable on domestic travel alone. It's now EBITDA positive, and it has a material exposure to the US, UK and Europe, whereas the companies that have underperformed, being Flight Centre and Helloworld, are those that are leveraged to Australian outbound travel, which isn't going to return in the short term. While these share prices, some of them are factoring in a degree of recovery, there is still, in our view, plenty of upside for the patient investor. So what we've done is we've said, look, what are these companies' 5-year average PE band? What did they trade on pre-COVID? And what we've done is they've applied that to their normalised earnings, or really, what were their earnings in FY19, adding in any acquisitions, cost-saving targets, structural changes they've made to their business during that time. So, look, we know with CTD, it used to trade on a PE band of around 25 times. So, taking that medium-term view, it's more a $29 stock, so there's still 37% upside from the current share price. Helloworld used to trade on 14 times, so there's over 100% from the current share price. Flight Centre used to trade on a PE of 16 times, so it's closer to a $20 stock. And Webjet's got the least amount of upside because, remember, it had the highly dilutive equity raising at the start, and then it's had 2 convertible notes since. So again, you can see from that slide the companies with the greatest upside to their long-term valuations is Flight Centre and Helloworld, but you're going to have to be extremely patient with those two because they are the late cycle recovery plays. Our strategy has always been to buy these travel stocks on weakness, continue to build your positions. CTD remains our key pick in the sector, just given it's best placed for all the reasons we've mentioned this morning. Helloworld is by far the cheapest in the sector, and it is materially undervalued. However, investors are going to need to wait for Australian international travel to resume. So it's really one for the bottom drawer for now. And Flight Centre, as we said, it's come material downgrades to 22. But look, I would look to probably be a buyer if it had a $13 in front of that share price. Just I think at that sort of $13 level or so, it justifies that time value of money, risk-reward equation. What I would note about that company is just given the changes to its business model, it's probably going to have the bumpiest road back. It's going to have the greatest execution risk. But at the same time, I do think they're going to win plenty of market share in the future as travel is going to be complicated and you're going to want an agent. And I just highlight that their corporate travel business is the absolute jewel in the crown. It is a great business and it's worth more than the current share price if you apply CTD type multiples.